Hi, folks. You're with Tacitus today, your pushback channel, and thank you for joining this audio live stream. Please listen to this presentation as you would a radio broadcast. In this essay, I'd like to talk about how very different the world was, the Western world was, in terms of home buying and residential real estate in years gone by. And I managed to get my hands on original bank documents, bank loan, mortgage loan documents from 1969. So, and they've got the do's and don'ts and the how-tos, and they really lay it out as to how the mortgage structure works and how the repayments are and so on. Here's a house where most of the houses, the repayments were, like $50 a week tops, and many were less than that. So, there's $60 a month the repayments on this other house I'm looking at going back in the day. That's 1969. Remember, it's Australia. So, but I think it was pretty similar sort of all around the Western world. Now, approximately, around 4 years, 5 years maybe of household income, which was considered to be just a primary income earner, breadwinner, was enough to was equal to the value of the house. So say the average wage back in the day was $5,000. So then house prices were $25,000, and earlier than that, when average wages were $3,000, houses were $12,000 or $14,000, and so on. So it gives you an idea as to the relationship between income and house pricing. Now, the bank lays out that they won't loan money to you for the mortgage, or the amount of money they will loan you can only be equal to 1/4 of your weekly wage. So let me just using round numbers here. So if you're making $100 a week, they'll only the loan they give to you will be to the maximum of $25 a week, 1/4 of your $100. And it seems like it was quite rigorously policed. And I remember sort of as a young kid listening to adults, talking about this sort of thing and how they would try and make up the difference. Now, that they wouldn't include the wife's income if the wife had an income. If the wife was under a certain age, they wouldn't include the income. If she's above a certain age, they would. So there were limitations on those sorts of things. And this is understandable, the idea. I mean, like if you look at the average, it was 2.5 children per woman back in those days, or even a little bit higher back in the 60s. So the assumption was if you were at a childbearing age that you would have children. And if you had one, that you would have more. So they wouldn't include, quite reasonably, by the way, it's not unreasonable, they wouldn't include the wife's wage. Now, at the time, say lesbian school teachers were outraged by this. And it's an attack on women, it's fascism, it's this and that, but it was nothing of the sort. And teachers had the option of going to teachers' unions to get housing loans and mortgages, which they did. So they could completely bypass the banking system. So the idea that the banks were uniquely oppressing women was of course nonsense. Coming back to the the pricing thing. Now, there were sort of two levels, I guess, or multiple levels. There are a few things to consider. That if you bought a block of land on its own, the bank took the view, and according to these documents, this was their attitude, that the appreciation of land on its own may not occur, and the price of the land could even go down. And they're warning buyers to say, look, don't overdo this by borrowing money for just buying a block of land, because in our experience, the price appreciation, the price inflation of just blocks of land on their own is very low, and we have many cases where the value of the land is less than you paid for it. So if you do get into trouble making the repayments, then you could end up selling the land and still owing money. And the banks were very particular. If you read the documents, very particular about, look, if you can't make the payments, the best situation to be in is where you don't owe any money after the property's been sold, like on to recover the mortgage value. So to look after your own interests here, and remember not to expose yourself in silly ways or in ways that you haven't thought out. And clearly the documents, as I was reading them, they're assuming that the person getting the loan is financially unsophisticated to the max, and that's fair enough. The bank's going out of its way to make sure the person getting out the loan doesn't get themselves into trouble, and that does come across throughout the whole document. So they also want you to have a certain deposit. Now, if the deposit, if you're just buying a block of land on its own, they want 1/3, minimum 1/3 deposit. And if you're buying a house land, particularly if the house land is ready, like the garden is turfed, it's got all the fences and everything's installed, and if it's a completely turnkey, if you like, operation there, then they still prefer you to have 25%. They'll haggle a little bit to 20%, but it was in that range. And clearly 25% is their preference. So if you want to buy a $10,000 house, you have to put $2,500 down, and the repayments have to be equal to at least 1/4 of your weekly or your monthly income. So there's a lot of safeguards built in for people getting carried away. But if you look at the documents, the assumption is that the price of real estate may moderately increase and so on, but they're not expecting it to move ahead in leaps and bounds. And this is an interesting thing that also comes across in those documents, that price inflation isn't anticipated, and if it is, it'll only be to a moderate level, and it'll only be for a very short burst. And again, reading the documents, even if property does go through a burst, the bank document suggests that it's likely going to fall back again, because they're assuming market forces will operate, and prices will wax and wane as a consequence. That's an interesting one. So now it's very, very different today that banks will not only loan. Also, another thing too, the banks were clamped down, or were quite severe on, that you get two loans. People that may borrow the deposit from one bank and then get the mortgage loan from another bank. This was very much frowned upon, and it was sternly advised against. Now, let's sort of fast forward to today, and houses are, firstly, household income. They would have primary income earner as the person in 1969, whereas now it's household income. The assumption is that two people are going to be working full time. Now, if you assume two people on the average wage, then houses houses are 4 times more expensive. Even if you assume two wages uninterrupted, and no children, they're twice as expensive as they were. If you add in, women coming out of the workforce for a while, maybe a few years while they're having children, and the cost of children, then that adds into the household income cost, or the household costs, and thus reducing the income. So if you look at the overall situation, houses and mortgages are way more expensive than they were, and how did this occur? I mean, there's a few things to look at. One is the entry level for getting into housing was lowered. So instead of 25% deposit or something like that, or even more, 5% was considered, and you could borrow that 5% from another bank. And clearly there was a switch around to say, well, price inflation, housing inflation is so vast and so continuous, primarily due to mass migration, that we're prepared to take higher risks and have higher risk profiles on loans. So, there's people I know who've got quite good household incomes. They're both in sort of have executive level type salaries, and yet they're living hand to mouth. I mean, they're really running running close to the wind financially, just so they can get into a nice house in a nice area. Now, a nice house in a nice area, say 1972, would be $25,000. That would get you into nice, in Australia, this is Sydney, nice house, nice area, tree-lined streets, nice schools, well behaved, well mannered, well brought up kids, and all that sort of stuff. 25,000. But now to get that same area today, you need to spend more than $4 million, closer to $5 million to get that same effect. So it's a very expensive business now. Now the average wage, back in the day, say was $5,000 in 1970. Now the average wage today is say 11, 12 times that, whereas the average house price is 100 times that. So it'll give you an idea as to the differential. There's lower interest rates today than were then, so that's a factor. But still, you're looking at monthly repayments of $50 or something back in the day, and today monthly repayments of $15,000, which will again illustrate the point of what it costs to live in a nice area. Even a shitbox in a shitbox area in Sydney now is pushing $1 million for the property. So this is part of the difference. But looking back on those documents from 1969, it just illustrates how careful they were, and how I would say prudent they were, financially prudent they were back in the day, but how it worked very well. House prices were low, people could afford them, people could afford, on a single income, could afford to have the dependent wife and 2.5 children. All that was afforded, have a car, go on an annual vacation. This was all possible back in the time on a single income, a single wage. Today the standard of living is much lower on two wages. Why are we so much worse off today than then? Or why is the cost of living so much greater today than it was then? What's changed? And other than mass migration, I don't know what the other rest of the difference is. You've been a Tacitus today, your pushback channel, and thank you for listening.